Who actually owns Canada's farmland? It sounds like a simple question. It isn't, because right now billionaires control over 1 million acres in British Columbia alone. Pension funds worth trillions of dollars are hunting for farmland deals across the prairies. And the Canadian government itself is buying up thousands of acres of prime farmland, not to grow food, but to build a $40 billion military radar system. This is the story of how Canada's most valuable resource quietly became a battlefield for the ultra-rich, and why almost nobody outside of rural Canada has noticed it happening. To understand how we got here, you have to go back to the summer of 2009. In the cranberry country of southern Quebec, near a town called Victoriaville, something strange started happening. Tourists usually came to this region for the harvest festivals and the postcard views of red bogs stretching across the countryside. But that summer, a different kind of visitor showed up. A $1 billion agriculture fund based in Boston, a subsidiary of one of the largest financial companies in the world, quietly purchased over 1,000 acres of farmland in the area. They wouldn't say how much they paid. They wouldn't even confirm the exact location. All they would say was that this was one of the most productive properties in the industry, and that they were in Canada to stay. At the time, this felt like a curiosity, a strange footnote in the business pages. Nobody imagined it was the opening move in what would become a multi-decade, multi-billion-dollar transformation of who owns the ground beneath Canadian agriculture. Here's the thing that most people don't realize about farmland. It isn't just dirt. It is one of the most quietly reliable financial assets on the planet. For more than 70 years, going all the way back to the 1950s, farmland around the world has appreciated at a rate roughly 2 percentage points higher than inflation, year after year, decade after decade. It doesn't crash the way stocks do. It doesn't evaporate the way cryptocurrency can. It is tangible. You can stand on it. And in a world where investors were watching their portfolios lose half their value during financial crises, a piece of land that quietly produces wheat, canola, or soybeans every single year started to look less like a farm and more like a bond that happens to grow food. Canada, in particular, became irresistible to this kind of investor for a very specific reason. It has the lowest farmland prices of any G8 country, combined with some of the most productive agricultural land on the planet. Low political risk, stable rule of law, a legal system where land ownership is registered, searchable, and essentially impossible to dispute. For an investor sitting in Boston or Toronto, or increasingly for a family office managing wealth from overseas, that combination is close to unbeatable. You are getting appreciating land in a stables. Democracy, with a clear paper trail proving exactly what you own. Compare that to trying to buy agricultural land in parts of the world where property rights are murky, where a different family might show up one day with a competing deed, and Canada starts to look like one of the last safe harbors for this kind of long-term wealth. So what does the scale of this actually look like today? Canadian farmland as a whole is now valued at somewhere around $1 trillion. That is the entire agricultural land base of the country, from the vineyards of the Okanagan Valley to the wheat fields of Saskatchewan to the dairy farms of Quebec. And here is the number that should stop you in your tracks. Institutional investors, meaning pension funds, private equity firms, and large asset managers, currently hold less than 1% of that trillion-dollar pie. That might sound reassuring. It is not, because industry insiders are now openly saying that this landscape is about to shift dramatically and fast. The reason comes down to demographics. Farming in Canada is an aging profession. Somewhere between 50 and 75% of Canadian farmland is expected to change hands over the next 10 years, as an entire generation of farm families reaches retirement age without a clear successor waiting to take over the operation. For institutional investors, that represents what one executive bluntly called a $500 to $750 billion opportunity. Some in the industry have even started calling Canadian farmland the last trillion-dollar investment left on Earth, a phrase that should probably worry you more than it excites you. So who exactly is buying? The names might not be familiar to most Canadians, but within the world of institutional agriculture, they are giants. 3 companies in particular, Bonnfield, Veripath, and Area 1, together manage more than 450,000 acres of Canadian farmland, worth an estimated $2.2 billion. These firms are backed by family offices, retail investors, and institutional money looking for stable long-term returns. Bonnfield alone, which describes itself as Canada's first and largest farmland real estate company, holds more than $1.4 billion in assets spread across 7 provinces, representing roughly 140,000 acres of Canadian soil. And this isn't a static number. In 2021, a Montreal-based asset management firm bought a majority stake in Bonnfield, specifically citing the growing appetite from both institutional and private investors who wanted exposure to farmland as an asset class. Then there is Quebec's massive public pension fund, the Caisse de dépôt et placement, which manages retirement savings for millions of Quebecers. In 2021, this fund announced it would deploy approximately 2 billion Canadian dollars over 5 years specifically into farmland and timberland. Think about that for a second. The retirement security of ordinary working people in Quebec is now directly tied to how much Canadian farmland is worth and how much it continues to appreciate. That is not inherently sinister. Pension funds exist to grow money for retirees, and farmland has historically been an excellent low volatility way to do that. But it does mean that the financial incentives driving farmland prices upward now include some of the largest, most powerful investment pools in the country actively competing against actual farmers for the same land. And it isn't only pension funds and specialized agricultural investment companies. There are also the extraordinarily wealthy individuals who have quietly become some of the largest private landowners in Canada. In British Columbia, a billionaire connected to major American retail and sports fortunes reportedly controls over 1.2 million acres of farmland, stretching across the Kamloops and Merritt regions. In smaller communities like Pemberton, local farmers describe watching prime agricultural land get purchased, not for farming at all, but so that multi-million-dollar private estates can be built where crops used to grow. This has become enough of a political flashpoint that provincial politicians in British Columbia have publicly called on the government to intervene, warning that the province's most productive land is being consumed by concentrated private wealth rather than the people who actually work it. Now, here is where the story becomes even stranger, because the biggest buyer of Canadian farmland in the headlines recently isn't a pension fund or a billionaire investor at all. It's the Canadian government itself. In Simcoe County, Ontario, about 35 kilometers west of the town of Barrie, the Department of National Defence has set its sights on roughly 4,000 acres of land, the overwhelming majority of it active farmland, to build something called an Arctic Over-the-Horizon radar installation. This is part of Canada's commitment to NORAD, the joint air defense system shared with the United States, designed to detect threats approaching from the north. The technology behind this radar system is extremely specific about location. It needs flat, dry land, and it needs to sit at a particular latitude, which happens to place it directly on top of some of the best farmland in southern Ontario. 50 different landowners received letters out of the blue informing them that the federal government intended to acquire their property or their neighbor's property for this installation. One farmer described the letter as coming completely out of nowhere, disrupting a life and a livelihood that her family had built over generations, with almost no warning that any of this was even under consideration. The total price tag for this project, incidentally, is estimated at $40 billion, making it one of the largest single government land acquisitions in recent Canadian history, and a striking reminder that farmland isn't only valuable to private investors. Strategic military planners want it too. But let's step back to the human cost of all of this, because behind every acre that gets purchased by an investment fund, there is usually a farm family making an incredibly difficult decision. Take the story of one farmer in southwestern Ontario, near London. When people ask him whether young aspiring farmers ever approach him about buying his land, he just laughs. Nobody does, he says, because nobody can afford to. That is exactly why, back in the spring and summer of 2020, he sold 4 separate properties to one of Canada's largest farmland investment companies. He didn't stop farming the land, though. Like a growing number of Canadian farmers in this exact situation, he simply started leasing it back from the very company that now owns it. This arrangement has actually existed in Canadian agriculture for a long time. Since the 1980s, somewhere between 35 and 40% of Canadian farmland has been farmed under lease agreements rather than direct ownership. But the identity of the landlord has changed. It used to be an aging neighbor or a relative winding down their own operation. Increasingly, it's an investment fund headquartered in Toronto, managing money on behalf of institutional clients who have never set foot on the property. Researchers who study this shift describe it using a phrase that sticks with you. They call it the emptying out of the countryside. A sociology professor at the University of Regina, who has spent years studying the growing influence of financial and corporate actors in Canadian agriculture, explains that deep-pocketed investors are making it virtually impossible for small farmers, and especially new farmers, with no family land to inherit, to ever break into land ownership. Think about what that actually means for the future of Canadian food production. If the only people who can afford farmland are large institutional investors and ultra-wealthy individuals, then over time, the actual farmers become renters rather than owners, permanently dependent on financial institutions for access to the land they work every single day. And farmers, as a group, are already carrying an enormous financial burden. Canadian agricultural debt reached roughly $146 billion in a recent year alone, according to Statistics Canada. Rising land prices don't just make it harder to buy in. They make the entire industry more leveraged, more fragile, and more exposed to interest rate shocks or bad harvest years. Not everyone in this story sees institutional investment as a threat, though. There are people within the industry who argue passionately that pension funds and large investors are exactly what Canadian agriculture needs right now. One prominent farmland investment executive in southern Ontario put it this way: farmland, he argues, is a fantastic diversification tool for a portfolio, with remarkably low volatility and stable returns that have held up for decades. It isn't just a feel-good investment story, he says. It has an actual demonstrable track record of solid financial performance. From his perspective, with so much of Canada's aging farmland set to change hands over the next decade regardless of who buys it, institutional capital represents a stabilizing force rather than a threat. Farmers approaching retirement need buyers who can actually afford to pay fair value for their life's work, and young farmers without family. Wealth need landlords willing to lease productive land to them on reasonable terms. In that framing, big investors aren't stealing farmland away from the people who work it. They're providing liquidity and continuity in an industry that would otherwise face a painful, chaotic wave of forced sales and farm closures as the current generation retires without successors. There's also a practical reason why institutional investors haven't already swallowed up huge portions of Canadian agriculture, and it comes down to geography. Farmland in most of the country is deeply fragmented, unlike buying an office tower or an apartment complex, where a single transaction can secure thousands of units under one roof. Farmland typically comes in scattered parcels of a few hundred acres at a time, owned by thousands of different families across the country. That makes it enormously difficult for the biggest institutional players, the massive pension funds managing tens of billions of dollars, to actually deploy meaningful amounts of capital. One farmland investment executive described the frustration bluntly, saying that piecing together a portfolio large enough to interest a major national pension fund, one capable of writing checks in the hundreds of millions of dollars at a time, causes serious headaches for those big institutions. It's simply hard to find enough contiguous, high-quality farmland in one place to satisfy that kind of appetite. This fragmentation has, in a strange way, been one of the only real protections keeping Canadian farmland from becoming entirely dominated by a handful of enormous financial players. But that protection has limits, and provincial governments across the country have spent the last decade wrestling with exactly how far to let this trend go. And the rules that exist today are a genuine patchwork, differing wildly from province to province. In Ontario, British Columbia, and most of Atlantic Canada, there are essentially no restrictions at all. No acreage caps, no residency requirements. A foreign investor, a pension fund, a private equity firm, anyone with the money can buy as much farmland as they want in these provinces, with no legal barrier standing in their way. That is precisely why so many international family offices and large-scale investors have concentrated their attention there. It's simply the path of least resistance. The Prairie provinces in Quebec tell a completely different story, and the reason traces back to a specific controversy that exploded roughly a decade ago in Saskatchewan. In 2013, the Canada Pension Plan Investment Board, the massive fund responsible for managing retirement savings for tens of millions of Canadians, announced it would spend approximately $120 million buying up nearly 47,000 hectares of Saskatchewan farmland. This set off a genuine political firestorm. Saskatchewan already had some of the strictest farmland ownership laws in the country, technically limiting foreign or non-resident ownership to just 4 hectares. But the pension board's corporate structure allowed it to slip through a legal loophole that hadn't been anticipated when those rules were written. As the pension board kept buying, eventually spending millions more on top of its initial investment, with plans to eventually deploy around $500 million total into Saskatchewan farmland, public anger only intensified. The provincial government opened up formal consultations, hearing from more than 3,200 residents, farmers, and businesses. The results were about as lopsided as public opinion ever gets. 87% of respondents said they did not support foreign ownership of farmland at all. 75% specifically opposed allowing pension funds to purchase Saskatchewan farmland. 69% were against allowing foreign financing of farmland purchases, even when the buyer was technically Canadian. And the vast majority, 85%, wanted the province's Farmland Security Board to be given stronger enforcement powers. The government listened. In 2015, Saskatchewan's agriculture minister introduced sweeping amendments to the province's Farm Security Act, specifically making pension plans and their administrators ineligible to own farmland in the province. Going forward, the changes also required that any financing for a farmland purchase come through a Canadian financial institution or a Canadian resident, closing the exact loophole that had allowed the pension board to buy in the first place. The logic here was straightforward. If a foreign lender financed a farmland purchase and the buyer later defaulted, that foreign lender could end up owning Canadian farmland through foreclosure, completely circumventing the spirit of the ownership rules. Farm groups largely celebrated these changes, even as some business associations warned that tightening the rules might scare away legitimate investment from the province. That was over a decade ago, but if anything, the regulatory pressure has only intensified since then, and some of the most significant developments have happened extremely recently. In October of 2025, Saskatchewan introduced another round of regulatory improvements, specifically removing any remaining ability for the Canada Pension Plan Investment Board to own farmland in the province, and giving the Farmland Security Board expanded authority to apply administrative penalties. The province also began requiring every landowner to submit full land registry transaction records when filing their statutory declarations, essentially forcing anyone who owns Saskatchewan farmland to prove exactly where their money came from and confirm their eligibility under the law. Then, in April of 2026, just a few months ago, the Saskatchewan government announced it would undertake a comprehensive legislative review of the entire Farm Security Act, launching a fresh round of public consultations. The stated goals include improving how ownership is verified, strengthening penalties for violations, modernizing outdated legal definitions, and increasing oversight specifically around permanent residents, a group that current rules don't always clearly address. Farm organizations in the province have gone even further in their demands, publicly calling for the Farmland Security Board to receive significantly more funding and staff, arguing that the agency responsible for policing all of these rules is currently underfunded and understaffed relative to the scope of what it's being asked to enforce. Saskatchewan isn't the only province where lawmakers have been pushing back. In Alberta, a member of the legislature introduced a bill specifically designed to prohibit pension plans and trust corporations from owning agricultural land in the province, essentially trying to import Saskatchewan-style restrictions into Alberta law. Around the same time, a member of Quebec's National Assembly introduced a separate bill explicitly targeting what advocates describe as agricultural land grabbing by powerful financial actors. Quebec already restricts farmland ownership over 4 hectares to Quebec residents and Quebec-owned corporations, but this newer proposal goes further, attempting to close a loophole where an investment fund could indirectly control farmland simply by purchasing shares in a corporation that owns it, rather than buying the land directly. Farmer advocacy groups pushing these bills forward have pointed to a staggering global statistic to make their case. Pension funds worldwide now control something in the neighborhood of $56 trillion in assets, and these advocates argue that turning farmland into just another financial commodity for pension portfolios risks making food-producing land permanently unaffordable for the actual people who want to farm it. Their argument doesn't stop at pension funds either. They're increasingly calling for limits on wealthy individual investors, hedge funds, and real estate investment trusts as well, all of which they say are driving farmland prices well above what the land could ever justify, based purely on its productive agricultural value. Meanwhile, at the federal level, the direction of policy has actually moved in the opposite direction in one important respect. In December of 2024, Canada's federal government announced it would remove a long-standing cap that had restricted Canadian pension funds from owning more than 30% of the voting shares in any single Canadian company. The stated goal was to make it easier for pension funds, which collectively control more than $3 trillion in assets, to make larger, more concentrated investments in Canadian businesses and infrastructure. While this particular change was aimed primarily at corporate investment rather than farmland specifically, it illustrates the much broader tension running through this entire story. On one hand, federal policy is actively trying to unleash more domestic pension capital into the Canadian economy. On the other hand, provincial governments, especially in the prairies and Quebec, are moving in the opposite direction, specifically trying to wall pension funds and outside investors off from farmland. 2 different levels of government pulling in 2 very different directions on the exact same pool of money. So where does all of this actually leave Canadian farmland today, in the summer of 2026? The fundamentals that first attracted institutional money back in 2009 haven't gone anywhere. Farmland values have continued climbing at roughly 10% annually over the past decade, according to industry analysis aimed at family offices and international investors. Political stability, functioning and searchable land title system, and genuine scarcity all remain powerful selling points. Advisors working with wealthy international families now openly describe Canada as offering something many other agricultural regions on Earth simply cannot match: a rock-solid legal guarantee of what you actually own, with essentially no risk of a competing claim ever emerging. For a family office managing multi-generational wealth, and that kind of certainty is difficult to find anywhere else in global agriculture. At the same time, the political backlash against this exact trend has never been louder or more organized. Farm unions are actively lobbying provincial governments, Public consultations keep returning results where the overwhelming majority of ordinary citizens want tighter restrictions, not looser ones. Independent politicians across ideological lines in provinces as different as Alberta and Quebec are introducing legislation aimed at the same underlying problem: deep-pocketed outside capital pricing, actual farmers out of the land they work. And all of this is unfolding against a backdrop where Canada's farming population continues to age, where family succession is becoming less certain, and where somewhere between half and three-quarters of the country's entire farmland base is genuinely expected to change hands within the next decade. That last point might be the single most important fact in this entire story. This isn't a hypothetical future scenario. It's already happening, right now, across the country. Every single year, more retiring farm families face the exact same decision: whether to sell to a neighbor, a relative, a stranger with cash, or an investment fund managing money for pensioners they will never meet. Multiply that decision across hundreds of thousands of acres year after year for the next 10 years, and you start to understand the true scale of what's actually at stake here. This isn't simply about who owns a few farms in Quebec or Ontario. It's about who ultimately controls the physical ground that grows Canada's food, who decides what gets planted on it, who profits when its value rises, and who gets pushed out when they simply cannot compete with institutional capital, chasing stable, inflation-beating returns. There's another layer to this conversation that rarely makes it into the headlines, and that's the question of food security itself. Canada is one of the largest agricultural exporters on Earth, feeding not just its own population, but millions of people around the world through exports of wheat, canola, pulses, and livestock. When ownership of that productive base shifts toward financial investors focused primarily on returns rather than food production, questions naturally start to surface about long-term priorities. Does a pension fund managing money for retirees in Quebec care whether the wheat grown on its land feeds Canadians first, or whether it gets sold to whichever export market offers the best price that season? In most cases, these funds lease land back to working farmers who make the actual planting decisions, so the immediate impact on what gets grown is often minimal. But critics argue the long-term trajectory still matters. If farmland increasingly gets valued as a financial instrument first, and a food-producing asset second, the incentives shaping how it gets used could slowly drift away from national food security toward whatever maximizes investor returns. Advocacy groups pushing back frequently draw a direct line between rising farmland prices and future grocery prices, arguing that every dollar added to the cost of owning productive land eventually gets passed down the supply chain. There's also a generational fairness argument that keeps surfacing in this debate, one that goes beyond simple economics. Farming has traditionally been one of the few paths in Canada where someone without significant inherited wealth could still build a stable, land-owning life, provided they were willing to work incredibly hard for modest returns over many decades. As institutional capital increasingly competes for the same limited pool of farmland, that pathway narrows considerably for the next generation. A young person today who dreams of owning and operating their own farm, without the benefit of inheriting land from parents or grandparents, faces a dramatically steeper climb than someone attempting the same thing 40 years ago. Some economists argue this mirrors what happened in Canadian housing markets over the past 2 decades, where large-scale investor purchasing made home ownership less accessible for younger buyers without family wealth behind them. Several researchers covering this issue closely have explicitly compared the financialization of Canadian farmland to the financialization of Canadian housing. Looking ahead, most people who study this industry closely expect institutional buying to accelerate rather than slow down. The demographic wave of retiring farmers isn't going away. Provincial governments can only regulate so far without triggering pushback from investors, warning about capital flight. And the financial case for farmland remains just as strong today as it was back in 2009, when that first billion-dollar fund quietly bought its way into a Quebec cranberry bog. What has changed is public awareness. A decade ago, these acquisitions barely registered outside specialized industry publications. Today, it's the subject of national investigations, legislative reviews, and heated debate at kitchen tables from British Columbia to the Maritimes. Whatever direction policy takes, the trend line looks unmistakable. Billions more dollars are coming for Canadian farmland, and the fight over who gets to own it is only just getting started. So, back to that original question. Who actually owns Canada's farmland? The honest answer today is that it's more complicated, more contested, and more financially significant than almost anyone outside of rural Canada realizes. It's family farmers hanging on through razor-thin margins. It's specialized investment firms managing billions on behalf of retail and institutional clients. It's massive public pension funds investing on behalf of millions of future retirees. It's individual billionaires quietly assembling private land holdings the size of small countries. And in at least one striking case, it's the Canadian government itself, buying up farmland not to grow food, but to defend the country's northern airspace. Whatever side of this debate you land on, one thing is becoming impossible to ignore. Canadian farmland has stopped being simply about agriculture. It has become one of the most quietly contested financial battlegrounds in the entire country, and the decisions being made about it right now, in boardrooms, legislatures, and kitchen tables across the prairies, will shape who controls Canada's food system for generations to come.